Okay, again, welcome and thanks for coming. Before we get into today's topic, I want to remind you of our fundamental philosophy. It's never what markets and economies do that makes you successful. It's what you do, or sometimes more importantly, don't do, that makes you successful. Anyone can follow some simple steps and become both financially successful and happier. It takes patience and discipline way more than it takes smarts. You can be financially successful. And remember, this is general information and education. Everyone's situation is different, so please don't think that this is specific recommendations. Think about what you learned today, and then before you act, ask some questions and get more specific answers suited to you. Most financial decisions involve trade-offs, and all investing involves risk. What we're trying to do today is get you on a solid foundation, so when you do start investing, you can stick with it. It is the plan you believe in and stick with that will bring you closer to your own financial success. Now, as we get going, stay engaged and take notes. Write some questions down that you have and ask them here at the end, if we have some time, or via the social media channels when it's all over. Welcome to Taking Control from Debt to Savings. Again, I'm Jonathan Dio. I'm the founder of Dio Wealth Management, the Happiness Dividend blog, the Mindful Money Toolbox, and I'm glad to be here talking about managing debt and getting to savings. It's the foundation, it's the very beginning of personal financial success. According to the Federal Reserve, Americans are carrying a staggering $3 trillion of all types of consumer debt. Of that, revolving debt, the largest portion of which is credit cards, accounts for nearly $1 trillion. The average credit card balance on an open credit card account is roughly around $1,500. There's much more work to do in each and every household to turn around the financial status of the American family. My goal here today is simply to help you assess your current debt load and spending habits and give you the tools to assemble a sound plan for successfully managing that debt, turning it around and starting to save. These tools are going to help you with a balance sheet, a spending plan, and a monthly budget. And hopefully you've already gotten these and downloaded them. We sent an email that had a link to the worksheets for today's webinar. If you haven't already done so, you can go to www.happinessdividend.com, click on the Mindful Money Toolbox, and look for real life series debt to savings worksheets, because we'll be using them as we go through today's presentation. So if you haven't already done it, go grab them right now. In theory, using credit cards shows that we have confidence in our future ability to pay. In practice, however, we often use credit cards for just the opposite reason, when we can't actually afford to pay. One reason many people overuse credit is that they're living from paycheck to paycheck and have no cushion for emergencies. But in the long run, using credit as a cushion can lead to debt and undermine efforts to help build savings and reach for important goals. Amassing debt isn't difficult today. We're bombarded with advertisements for thousands of must-have products and inundated with credit offers, pre-approved credit cards, increased credit limits, and department store credit lines. So what can get you into trouble is the inability to use credit wisely. Spiraling credit card debt often comes from impulse buying. But no matter what your income, you can dig yourself out of debt by spending less than you make. That may sound simple, but first you've got to know exactly how much you're spending and find ways to cut back. For many people, the hard part is getting started. But you have a leg up. You're here today to learn to manage your money more effectively. So you've got the start. We're going to begin by analyzing your expenses and your spending habits. Then we're going to discuss how to use debt wisely, and you'll learn how to create a budget to address both your debt and your spending needs with an eye towards building savings for the future. And we're going to show you how to reduce debt and stay out of financial trouble next time around. After today's seminar, you should be prepared to change your financial situation for the better, perhaps in as little as 6 months. Let's begin by creating a personal balance sheet, itemizing your debt as well as your liquid assets. Now, hopefully we sent you that email or you went to our website a moment ago to get it and print it out. But spend some time and complete worksheet 1 right now. This is your personal balance sheet. If you have records of financial statements in front of you, fantastic. Feel free to use them. If you don't worry. Just complete the top half of the first and second column of the worksheet as best you can from memory. I'm going to give you a long minute here so you can do it. Okay, I hope you're able to do that. Now, staying on the worksheet, total up your liquid assets, including any savings and investment accounts. Don't consider amounts in IRAs and other retirement plans here. Calculate how much you would need to cover a minimum of 3 months of living expenses, ideally 6 months, and subtract that amount from your assets. You want to give yourself this cushion in case of some unforeseen crisis like losing your job or a medical emergency. Also, subtract any major purchases you expect to make in the next year. What remains, if anything, are your net assets, and we're going to refer to net assets later. These are the assets from which you could start to pay down your debt. Now, looking to the right, take a look at your liabilities. List your debts in order of interest rate from highest to lowest. I'm going to give you another long minute here. Well, how do things look? Debt comes in many forms, some useful and necessary. About 40 years ago, your parents may have paid cash for their homes or their cars. How many of you paid cash for your home or car? Do you even know anyone that paid cash for a car or a house? If you have a mortgage or an auto loan, you're carrying what's called installment debt, meaning you pay a portion of the total due at regular intervals over a given period of time. Installment debt helps us get what we need when we need it. Similarly, school loans and small business loans can be a valuable investment in your future. However, carrying credit card debt, on the other hand, is usually very counterproductive. I want to take a closer look at those little plastic traps. Do you know the interest charged by each of your credit cards? The national average APR on all fixed rate cards is currently a little over 13%. For variable rate cards, the average APR is currently a little over 15%. But fierce competition does force companies to offer better deals. If you must use credit cards, it's absolutely worth taking the time and looking for lower rates. Last week, I actually reviewed a friend's finances and discovered that their 7 cards, with an average balance of $6,000 each, had an average interest rate over 18%. He was paying an average of $650 in interest alone every single month. Now, how did he get there? Well, we got to keep in mind that many credit card companies offer lower rates for an introductory period only, and then they jack up the rates after you rack up the debt. But if you can find a card with a reasonable rate and no catch, consider transferring your balances. Why pay 20% interest when you can pay 8 or 9? Why pay annual fees? Many companies will waive them. How many cards do you carry? If you're carrying a balance on each card you have, you've got a better chance of losing track of your balances. Limiting the number of cards you use can help you keep tabs on your spending. We're going to talk more about this later, and we're going to talk about how to eliminate extra cards. A recent change in banking regulations required higher minimum credit card payments from millions of American consumers. Now, the idea behind the payment hike was not to hurt consumers. Absolutely the opposite. It was supposed to help consumers pay down their balances faster, with a greater percentage of their payment going to principal instead of interest. Generally, when credit cards previously required customers to pay off 2% of their outstanding balance each month, most now require customers to pay off all monthly interest and fees and 1% of outstanding principal, so that every single month they're paying off at least some portion of that principal. The minimum payment is still a fraction of your overall balance. Under the standard payment system, if you continued to pay only the minimum required, you would pay primarily interest on the debt, and you would stay buried in a never-ending cycle of payments, especially if you continue to use the card while you are making those payments. The longer you carry a balance, the more total interest you pay. Now, this is something that most people don't know when they begin using their credit cards, and something you have to learn, hopefully not the hard way. Now let's just assume for a second you have 2 debts of $2,000 each. One's in the form of an installment loan with a fixed payment each month. The other on a credit card that charges a minimum monthly payment based on your balance. both charge an interest rate of 18%. The first minimum monthly payment to the credit card would probably be 5% of your balance, or $100, and a minimum monthly payment of $10 thereafter. If you continued to make only the minimum monthly payment after that, as they gradually decreased, it would take you 89 months, more than 7 years, and cost more than $800 in interest to pay off that $2,000 on the credit card. But your installment loan would charge you $100 every month, and you would pay off the entire balance in 24 months for a total interest cost of only $394. Of course, these examples are hypothetical and for illustrative purposes only. Your actual results will be based completely on the variables of each piece of debt you might have. The way to pay off debt on a credit card is to treat it like a loan. In other words, pay a fixed amount every month. A little later on, we're going to look at this with more detail and see exactly how you can do it. The average credit card balance on an open credit card account is, again, just about $1,500. So let's go back to the worksheets. Look at worksheet 2, and we can calculate a debt-to-income ratio to get an idea of where you stand. First, tally all the payments you make each month to credit card companies and other creditors. Exclude your mortgage at this point. Divide that figure by the amount of money you take home after taxes every month. If you multiply that result by 100, you'll get a percentage figure for the ratio of your debt to your income. So where do you stand? As a general rule, if your debt-to-income ratio is less than 15%, you're probably in pretty good shape. Anything more than 20 could indicate trouble. Next, we want to take a look and see if you are overextended. So we have a list of boxes here on the second worksheet. Check the box if you don't know or don't want to know how much you owe. If you borrow for things you once paid for in cash. If you have to juggle other bills just to pay the minimum charges on your credit cards each month. Check a box if you pay each monthly credit balance, it gets higher and higher this month relative to last month. Check the box if you pay bills using money intended for other needs. Check the box if your creditors are sending you overdue notices. And finally, if your savings or emergency funds are not enough to cover 3 months of living expenses, that's a good indicator. Do any of the scenarios on worksheet 2 apply to you? If you checked even one box, it could indicate a potential problem. So, how do you start to dig out from under your debt? You're going to want to start by finding out where your money goes each month. So let's go to the third worksheet, monthly spending. Take a few minutes to write down all your typical expenses for 1 month. Use the categories listed and add some of your own if you have to, but make sure every one of your expenditures fits in there somewhere. So I'm going to pause here for a long minute and let you fill that out. All right. So hope you were able to do it in that period of time. We're gonna move right along here. So I want you to total your expenditures and write down your monthly salary after taxes. In other words, the amount you actually take home for comparison. Are you spending more than you take in? If so, you'll need to identify where you're overspending. So let's take a closer look at each category. Look especially closely at the big ones. Where is most of your income going? Is the dining out category more than the groceries? Is entertainment too big a chunk? You may need to cut back or compensate by trimming somewhere else. Because what we've just done is based mostly on estimates, you probably have a good but imperfect picture of your money outflow. Throughout the next month, keep track of your expenditures on a daily basis and then update this worksheet. At the end of each day, write down any purchases you made either in cash, by check, debit, or credit card. Be sure to include all bills as well. Total up your total outlays and compare it with your monthly income. It may help to do this for more than 1 month to get a very solid picture of your normal spending patterns. Next, you need to think about it. Can you decrease your spending in other categories to allow to allow for more to go towards debt payments. Let's find out by creating a monthly budget in which you designate a set dollar amount for each category, including debt and savings. As you get more precise with the picture of your monthly spending, you can modify the plan to fit your needs. You should create savings by budgeting for it each month. Financial professionals often recommend saving a minimum of 10% of your income each month, and I'd love it if you could do between 15 and 20% of your income. That would get you to all your goals a lot faster. Building savings is key to reducing debt because you'll have money to fall back on in emergencies and avoid the use of the credit cards to begin with. Okay, turn to the fourth worksheet. Let's create a budget for 1 month. Remember that although a review of old spending habits can help you determine realistic figures, your budget should be a guide for allocating your income wisely. So this is part aspirational, though it should be realistic. You want a plan for the future, not a record of the past. With the information from 1 month, create a draft 12-month spending plan with worksheet number 5. Be sure to include your new savings and debt reduction figures. You'll want to include all sources of income and all fixed and variable expenses. When we're done here, you can use last year's pay stubs, checkbook register, and credit card and bank statements to help you fine-tune the plan. You'll notice that the worksheet contains blanks for both planned and actual expenditures each month. This comparison allows you to see how well you follow your budget once it's set. It does little good to make a budget you can't stick with, so be realistic and remember the plan is a draft. Review and update it often until you have control of your spending. But don't be rigid. You may need to modify your strategy to accommodate changes in your situation. We all have to admit that life's change. Income goes up, challenges hit us. Take a couple minutes to start doing this right now. When you have a good start, we can come back and do it on your own time. I'm going to give you just a really long minute here. Paying off your debt is one of the best investments you can make, and it's entirely risk-free. If you have savings in a bank account, for example, consider using some of that money to pay down your debt. Why give up part of your savings? Because you actually save more over the long term by getting rid of these interest payments. Let's look at an example of how this works. We're going to look at 2 scenarios. First, let's say you owe $1,000 on a credit card charging you 18% interest annually. Meanwhile, you have $1,000 in net assets, not including your 3 months of living expenses. We don't want to dip into that. Sitting in your bank account, which is paying you 1.25%. At the end of the year, you would have paid out $180 in interest on your credit card balance and earned $12.50 in interest on your bank savings account, resulting in a loss to you for the year of $167.50. But if you had taken your savings and used them to pay off your credit card debt, you'd have broken even, a much better result, saving that $167.50. Another option might be to take out a low-interest loan to pay off your debt. If you have substantial equity in your home, a home equity loan may be especially appealing because the interest paid is generally tax deductible. That's a double benefit, a lower interest rate and tax deductibility. A tax advisor can help you determine if this may be appropriate for your situation. If you don't have a lump sum of savings to pay off your debt all at once, you can still save on interest payments if you gradually decrease your credit card or loan balances by paying well more than that minimum payment. The important thing we're trying to get across here is you can gradually pay off all your debt this way. From your monthly budget, designate a set amount to pay each month on each balance you carry. Allocate the highest payment to the card with the loan with the highest interest rate. As each balance is paid off, add those payments to the next card or loan until they are all paid off. This is often called the snowball effect. Set up a realistic payment schedule and stick with it. If you need to, readjust your schedule. It's better to set yourself back a little than to give up entirely. All right, let's take a look at the last worksheet. Worksheet 6. Using the sixth worksheet, you can estimate how long it's going to take you to pay off each debt given your current payments. Then, for comparison, run through the calculation a second time using the new payment amount you budgeted. This is the amount of time you're going to save towards now and when you're going to start saving. Remember that the longer you retain a balance, the more total interest you're going to pay. Now, I'm going to give you another long minute here to start doing this right now. Once you reduce your debt burden, take steps to prevent it from returning. Limit your use of credit cards. By carrying one, two at the most, you can lower the temptation to charge. If you put all your purchases on one card, you'll have one statement. It'll be easier to track your spending and then pay off your balance every month and use the second one only for emergencies. Cancel credit cards that have really high interest rates on them and leave your cards at home unless you know you're really going to need them. So once your debt's handled, what will you do with those extra monies that you'd previously allocated to debt service? Well, save them, of course. A key to increasing savings is to make it easier to save than to spend. Establish a savings account if you don't already have one. When you get paid, put only what you need to live on for that pay period into a checking account. Deposit the rest into savings. Or you could set up automatic monthly transfers from checking into savings or investment accounts if you'd like. But investing is outside the scope of today's presentation. You can always check out our 3-part Mindful Money Investing program to come up to speed on investing. For now, we're going to focus on building your savings once you've paid off your debt. So today, you have likely identified a need to modify your spending behavior. So follow these basic guidelines and this could help. First, think about purchases before you make them. Think of things like needs versus priorities. Do you really need this or is this something you just want? Can you explain why you need to make this purchase? If not, don't make it. Until you're out of credit card debt, don't use your credit cards. Use cash or debit cards whenever possible. Even if it's just for a partial payment, charge the rest only if it's emergency. And always look for additional ways to save money. Examine your insurance policies for potential savings. You can raise deductibles and eliminate unnecessary insurance policies. Determine if any assets can be sold, especially items that you're making payments on but aren't using very much, like boats or snowmobiles or motorcycles. It might sound obvious, but be conservative in your use of utilities, electricity, gas, and phone. Try cutting down on pleasure spending, shopping trips, eating out. Review your cable. Does anyone need any more than basic cable? Does anyone really even need basic cable? Buy in bulk at discount stores, use coupons, buy generic goods. There's all kinds of ways you can save money. Make a list before you go shopping and stick to the list. All kinds of things you can do. Just start doing them and saving. If you find yourself getting into trouble, be sure to communicate with creditors regarding repayment plans and better deals. You won't be able to get rid of all your debt overnight. You've got to be patient. But get started today and stay disciplined. Our strategies will begin to lighten your financial load, and getting rid of your debt is good for your family's long-term future, and regaining control will help you feel better as well. You will feel more successful, a little psychological benefit. You've heard me say it before, and I'm probably going to say it 100, maybe 1,000 more times before I'm done. It is not what markets or economies do that makes you successful. It's what you do that counts. Start now. Use these worksheets to create a plan. Stick to the plan patiently and with discipline, and you will reap the rewards. It is always and everywhere in your power to change the path of your financial future, but only if you start today. Thank you for attending the first in our real-life series From Debt to Savings. Our Mindful Money Investing 3-part video is available in the Mindful Money Toolbox, and when we finish this series, it'll be up there as well. Very soon, you're going to be able to become an engaged member of Happiness Dividend, and our first 100 members will receive access to all of our content for as long as they're members. Check out the Mindful Money Toolbox for more details. As always, if you think this content is valuable, help me spread the word. Follow us on Twitter, tweet about us. Like us on Facebook, post some of our events, become part of the conversation, reach out and tell someone to subscribe, help someone else educate themselves, and start to get ahead. Thanks again for spending so much time with us today, and as always, I wish you so much more than luck. And we're going to finish up right here and take one last look at this disclosure. Please read it at your leisure. And then we can open up for questions. So bear with me right here for just a second while I change things back and get the video camera turned back on.